David Buckland from the Montgomery Fund. Welcome to the program. Well, it's certainly been a very robust start to the year. It's my first appearance on the show, and certainly good to be on when the market is high. But the questions that come from it are equally as challenging, and not everybody does, of course, get the benefit of the market rally. So, David Buckland, welcome to the show, and welcome to reporting season. And David, is there a lot of value around, or do we need something special from reporting season to sort of prove it up?
I think value is difficult to find on a sustainable basis. I think what we've got here is really a yield-driven sort of bull market. What's effectively occurred is cash rates now are starting to really get very low. Obviously not as low as Europe, UK, Japan, America, but they're starting to get very low. And as Roger often makes the comment, if you retire with $1 million, you used to think you were rich, but now you're earning less than $30,000 in fixed interest on that $1 million. And so it's forcing my parents' generation to stop earning the $30,000 on the million and actually starting to make part of it work. Yeah. And as interest rates keep declining, they're forced, in a funny, odd way, to actually take more risk. And this is exactly what's occurred over the recent weeks.
Enrique has sent us an email. He said, "Hi guys, I would like to get your opinions on Sydney Airport and Transurban. Do you think they're a good buy right now?" Now, that's, I think, a really good email, because it speaks to both of the answers you guys have given me tonight there to start the show. Both, I think, at a time were excellent, solid infrastructure stocks that paid high yields. They've gone up a lot. When price goes up, yield goes down. David Buckland, would you buy either of those now?
Well, you're exactly right, Jeremy. What has occurred in both cases is it's a highly reliable infrastructure assets. You know, the people at both companies pretty much can predict their revenue lines extremely closely, and there's obviously a certain amount of growth. You know, we see the prices of either toll roads or every time you go to Sydney Airport just go up by that 3, 4, 5, 6% every year without fail. So it's always got a bit of growth, and they've also they're lumbered with a lot of debt. Yes. These businesses, but very, very reliable earnings stream, lumbered with a lot of debt. So what happens is, as interest rates keep being compressed, the valuations for these stocks do go up. But, you know, at the end of the day, in traditional terms, they're on P's of 40 times or 50 times or what have you. But they are paying out of their cash flow dividend yields of maybe 4.5% or 5.5%. So once again, it's really a yield play, and it's a compression of interest rate play. And one day, not today or tomorrow, but one day when interest rates reverse, these are exactly the sort of stocks that will get hit hard because they've enjoyed this compression of interest rates so enormously. Yeah, no, excellent.
Good return on equity, David Buckland, but is earnings certainty or uncertainty a bit of an issue for a company like this?
Yes, that's right. So there are several, I'll call them second-line telecommunications companies that have developed superb niches where I'll call it their predictability of earnings is quite high. And so what actually happens is there's a number of them. So M2 Telecommunications has been a classic, both through acquisition and organic growth. They've been able to grow their earnings very, very, very solidly over about a 10-year period. Now, I don't know enough about MyNet phone, but the idea clearly is when you're analysing these sorts of stocks is be able to understand their earnings drivers, what niche they have, and do they have a high level of predictability of earnings to the degree that you can sort of say, with your hand on your heart, the earnings could be much greater in 2 or 3 years' time than they are today. And if that's the case, there's a high probability the share price will do well. But as I say, I don't know enough about this one, but I'd suggest that the caller, you know, understands those earnings drivers, and if he's confident, then it'll probably do okay over the longer term.
Yeah, okay. Well, thanks very much for that, guys. Our next caller's on the line. We've got Shane there. Shane, good evening.
Hello, boys. Thanks very much for giving your time.
Thank you.
I just wanted to ask about Tabcorp, when it might come back online and when you've got to buy it for to get that extra dividend.
Yes, okay. Very good question, because Tabcorp reported today. It was one of the first out of the blocks in reporting season. David Buckland, did you get your eyes across the Tabcorp result, or is it?
We actually had a very good look at Flexi Group, which we own,
yes,
and realestate.com, which we do not own.
Yes,
it's just a bit expensive for us. But Tabcorp, we haven't owned it simply because for us it's just too expensive versus our valuation. I mean, clearly it's I would say it's a business that generally has relative reasonable predictability of earnings. But for us, its return on equity is a bit low. It's like a 10 or 11% return on equity type business. We're shooting for businesses that maybe have 20% ROEs or higher and high incremental return on new capital. So it's one that really hasn't sort of got onto our radar screen from a price point of view.
Good evening, Peter.
Good evening, guys. Just like to get the panel's view on two stocks being Ansell and REA Group.
Okay, yep, terrific. Ansell and REA. Thanks for your call, Peter. And two good stocks, certainly one that was in the news today. I was on the teleconference line and was very impressed by REA. David Buckland, you were
equally impressed.
Yeah.
The issue for us, Peter, unfortunately, is it's a brilliant stock. It's just a bit too hot for us, share price-wise. But it ticks all the boxes. It's got a brilliant balance sheet. It's got massive return on equity. It's got massive return on incremental equity. It ticks all the boxes. It's just the missing jigsaw part of the jigsaw puzzle for us is price.
Do you have that as a price objective where it would be interesting for you, David?
Yeah, I would say possibly about 10% cheaper.
Yeah, okay.
Where we'll be sort of having a serious look at it.
So maybe $45 or something.
Correct.
And of course, I guess the thing to say is admiring quality in a business, but paying a bit too much is often less of an evil than doing the other, finding a business which is out of sorts and might look cheap, but it doesn't ultimately deliver.
Very, very good businesses. Yeah. The share price will be looked after over the medium to longer term.
Yeah.
And we've seen that with those 5 or 6, I'll call them superb stocks in Australia, of which obviously CSL is one, REA is another, SEEK's been another more recently, but there's probably 5 or 6 in Australia.
Yes.
Where, of course, at the time you look at it and you go, gee, Ramsay's another one.
Yes.
I've paid a bit too much, but you look back 5 years later and you go, I probably paid too much, but the quality of the business looks after you over time.
Yeah, no, great. Yeah. David Buckland, I mean, Ansell, I would regard as a quality business.
Yes.
I'm not sure I'm comfortable with the price. It's reporting February 16, I think. What do you think?
Well, I would agree with that, Jeremy. We haven't owned it. It's always been on our sort of short list without owning it. The return on equity is probably sub 14%, probably not sort of sexy enough for us in a way. So it's there or thereabouts.
Pun intended. No.
Yeah, that's right. It's there or thereabouts, but just hasn't quite made the grade. In terms of the quality's probably nearly there, but probably just has never been quite cheap enough for us.
There are some caveats with this space. Guys, any comments about capital notes, hybrid securities of this kind, generally speaking?
Yes, I think Chris Joy from the Australian Financial Review has written about these instruments extensively. And there's 2 or 3 points to make. The first point is they are cheap capital for the banks. They're regarded as tier 1. I'm not sure if they're a great buy for the investor. And the reason I say that is because you've got to read the fine print very, very closely. In one case, there is absolutely a discretion on whether that yield is paid. Now, it's not contractually a contractual obligation like a coupon on a bond. It's at the discretion. And if we had another GFC, I can absolutely guarantee the discretion would be, hey, we're not paying this year. Now, what happens to the price of that instrument if the management woke up one day and said, we're not paying that coupon this year or this half year? It would get smashed. And that's one of the reasons when they list, they don't often list at a premium, they often list at a discount. So you've got to be very aware, and as I said, Chris Joy from the Fin Review has written extensively about these. I think sometimes it's better to just buy the underlying instrument, for example ANZ, and take the yield rather than necessarily buy the hybrid. So that's something to very much consider. I think chasing yield You've really got to weigh up the risk of that yield, David, and that you've really got to read the fine print with these instruments. The final point, are banks cheap? No, of course they're not cheap. If you look at banks anywhere in the world, our banks in terms of their 2.5 times NTA are definitely expensive. But what happens is we have this thing called the superannuation guarantee levy. It's $2 trillion. It's forecast to go to $7 trillion in the next 20 years. And people who have a lot of super have to try and get a return on that super, so they invest domestically, particularly for fully franked dividends, and so they invest in this very, very thin market, and they chase things with yield. And the banks, because of that monopolistic connotation or that nice cartel, they've done particularly well. They really did avoid the GFC in a fairly significant way, unlike most banks in America, Canada, Europe and the UK. They did very well in the scheme of things. They still needed the federal government to step in and back them. But at the end of the day, they are not cheap instruments. Yeah, no. They are there primarily because interest rates are at record lows.
Cool.
Right. You're welcome.
I've just got a two-part question. Our first question is on Cedarwood, CWP.
Yes.
The property development at Western Australia. With the low interest rates, it's got good tailwinds, it's got a really good balance sheet. They've just had approval for the Upper Kendron in Brisbane.
Yes.
And also Western Australia and I think Queensland, which they're mostly developing, has got good population growth. I was just wondering whether to buy back. I already own the stock, but I got it probably a bit below this price. Was it worth buying more into at this price? And also there's a bit of a competitor, well not so much a competitor, of Finbar,
yes,
which is also a Western Australian company as well. Mate Trantino just wants to know, is that a good time to buy because it's been on a dip?
Yeah, sure. Great. Thanks for your call, Michael. We'll have a look at the two WA property groups, Cedarwood and Finbar. There's a yield there. There's a bit of excitement. There's a bit of volatility though, David Buckland.
That's the problem, Michael, is the volatility in terms of the predictability of earnings of these companies is low, in that they can go for long periods where they make quite excellent numbers, and then they can go for long periods where they can make very poor numbers. And for example, if a large project falls into the ensuing financial year, the year just gone by might be hit quite hard with the numbers. But that said, both companies, as you say, Michael, probably have quite a good tailwind. I should also point out though that the household debt to disposable income in this country has been running, at very, very high levels now for about 5 or 6 years. So it's really been the investor market to some degree that's got this space going. But the average householder still has a lot of indebtedness and has had so for about 6 or 7 years. So from one side of the coin, it doesn't look like an easy space to be in, but on the other side of the coin, with the investor market wanting to chase these sorts of assets, it does look like it's got a good tailwind. But in both cases, our valuation is neatly higher than the share price. In both cases, the return on equity generally is quite high. In both cases, the balance sheets are reasonably solid. And in both cases, they don't look overly expensive. So I think it's one that it would certainly be due some additional homework.
Okay.
Yeah. David's got a very good point there, Jeremy, and that is that this Western Australian economy, we had iron ore prices at, $100 to $180 a tonne for some years, and now it's in the low 60s. And we had oil prices at above $100 a barrel for a few years, and now it's sort of in the 40s or 50s. And there's a lot of projects that have this sort of superb multiplier effect into the broader economy. The companies that service those two sectors, the oil and gas sector and the iron ore sector. And now it's battened down the hatches from those sectors. And so there's a lot of companies that were servicing those sectors that are going to see a really, really, really tough period. And they're going to be laying off. Everyone's battening down the hatches. And, one has to be aware of that, particularly if these companies end up with a lot of stock and they're trying to sell that stock. There may be pressure on that stock.
Yeah. They're great comments. And I think where it comes to a valuation perspective for Michael is that you can't really compare these kinds of property investments to those in more stable earnings bases on the East Coast. And you do need to get cheaper multiples and better yields when you're buying either of those kinds of stocks. So they're not going to compress to quite the level of the office trusts and the like, which are based in Sydney and Melbourne. That's just how it is. Thanks for your call, Michael. Our next call is on the line, and we have Abe from Sydney. Good evening to you, Abe.
Oh, thank you very much for taking my call. I'd like to ask the panel medium-term outlook on Crown Casino and Sigma Pharmaceutical, please.
Okay, Crown and Sigma, thanks for your call, Abe. Crown certainly of interest. I do like Crown. Sigma's not one I've looked at. David Buckland, either of those of interest to you?
Crown is a better business, but just too expensive for us. Okay. Has a lot of good attributes. Its indebtedness is not over the top. It's got a reasonable return on equity. It's got a reasonable return on incremental equity, but it's just been too expensive for us, Jeremy.
And obviously the chart's on screen now. It's come down a fair way, notwithstanding the bounce over the last week. But certainly the back end of last year was pretty unkind to it. So you're needing it further into the $10 or $12 level?
That's correct, yes. So what actually happened last year was we did see, particularly with the austerity program in China, Macau got beaten up left, right and centre. And we saw table revenues in Macau year on year down numbers like 25 to 30 percentage points. Okay. And so to think that this is a space that's stable, it is not stable.
No, there's many. Yeah.
And it's not just their half-yearly report, Jeremy, it's also their commentary. Because what's happened is that a lot of these businesses are only just started to be hit in the last 6 months. And I think the commentary about the balance of the calendar 2015 year is really crucial to understand the prospects of these businesses. And I just basically take a view that unless the prospects are, very, very solid.
Which they're unlikely to be.
Which they're highly unlikely to be. You might have something that's in a very specialised niche in, for example, the infrastructure space, which might be backed by, say, a lot of government spending. But if it's more broadly in the mining services space, the oil and gas space, the iron ore space, then, I just think it's basically going to be tremendously difficult.
Is that how you see it, David?
I think opportunities always present. What happens is there's always something from left field that you least expect that'll come along and make the market or selective stocks within the market cheaper. And there's always going to be high quality businesses that come to a price that's reasonable. And I think for people who have got money burning a hole in their pocket, earning only 3% or 2.9% now, they definitely have an opportunity to put some money in the market, but they've got to be selective and they've got to be discerning.
Yes.
I think that's very important. And I think just going and buying for the sake of buying is a bit of a mug's game.
Yeah.
I think also what has happened is that in a way the compression of interest rates are punishing people who've been really great savers.
Yes, it is.
So it's in a way it's sort of very, very
slightly unfair,
in that these poor people now end up having, or these wealthier people now end up having to take greater risk because the market's rallied. But I do know one thing, and that is bear markets very rarely commence until the last person has sort of bought the stock. So we haven't gone through that phase yet where people have been, pushed into the market. I would suggest if we have one more interest rate cut, which I think is definitely on the cards if our domestic economy slows, and then what happens is you get this whole wave that might last 6 months, and then what happens is that once the last people are sort of bought, and then that's how bear markets tend to commence.
Price peaks and risks at the same time, and that's the thing that people do have to take care of. I think very good advice from both our Davids here tonight. Monadelphous, former darling of the market, David Buckland, certainly not now.
So this is the bellwether stock in the service area. It had basically a superb decade, and it's over. So this stock has come back, Alex, as you probably know, from the very high $20 area to, $8.80 or thereabouts. And as I say, it's been the number one player in this space. It had the most marvellous decade, but the last 12 months have just become incredibly problematic. And I would suggest that 2015 and 2016 could end up becoming, very, very, very problematic for this company, because I see a scenario where a lot of its competitors both listed and unlisted, are going to end up going broke over the next 12 to 18 months. And what will happen is that the rating of this stock will have trouble, being re-rated, even though it's the number one player. So the business side will decrease, and it'll just end up becoming a trading stock. So when oil and iron ore bounce 5 or 10 or 15%, it'll bounce. And when oil and iron ore, etc., falls, it'll fall. But at the end of the day, I see a scenario where a lot of the companies in the sector, both listed and unlisted, will in fact have to call in the administrators over the next 12 to 24 months.
Could that benefit Monadelphous?
Long term, yes, because what will happen is we'll always be mining, and we'll always be trying to get gas out of the ground, and things will come back one day. So they will end up picking up a certain amount of volume one day. But in the short to medium term, I think the prospects just look pretty somewhere between dim and ugly.
Yeah, thanks, David. Not much of a return from where we are now, David Buckland.
No, it's only a few hundred points away, and can certainly, another threat of another interest rate cut, it could do that again.
Yeah.
So that's, as we say, it's very much yield driven at the moment,
Yes.
and I think, with the slowing domestic situation and the poor commodity prices and the acknowledgement that the resource super cycle is well and truly behind us, I think there is very high probability it could counter through to 6,000, assuming we don't get a Greece or a Ukraine or a Russia type scenario.
Yeah.